when countries want to have these alternative payment systems that can't be shut off by external entities, Bitcoin's a fast settlement. Instead of literally just flying, planes of gold to each other, or relying on a credit-based system, which again can just be frozen or confiscated in many ways, a Bitcoin transaction can be sent and audited, depending on the size and how many confirmations you're looking for. I mean, within the hour. There's basically both a settlement and a store of value aspect that's really valuable.
For decades, the global financial system has operated on a fragile foundation, one built on trust, intermediaries, and ultimately, control. But what happens when that control is weaponized? When access to money itself becomes conditional? That's the question more countries are beginning to ask, and increasingly, they're looking for alternatives. In today's video, Lyn Alden breaks down why Bitcoin is quietly emerging as more than just a speculative asset. At its core, she argues, Bitcoin solves a problem that has existed for centuries: the inability to move value quickly, securely, and without reliance on centralized power. We're already seeing early signs of this shift. Countries facing restrictions, like Iran and Venezuela, have explored Bitcoin and stablecoins as alternative financial rails. Not because it's trendy, but because traditional systems can be shut off. When that happens, speed, neutrality, and final settlement become survival tools. And Bitcoin offers all three in a way no legacy system can. But Alden doesn't make the case blindly. She acknowledges the reality: Bitcoin is still small, still volatile, and still early. The real question isn't whether it can become a global reserve asset, it's whether it can overcome the hurdles that come with that role. And that's exactly what we're breaking down in this video. How does Bitcoin move from a $1 to $2 trillion asset to something central banks actually hold? What needs to happen for it to compete with gold, and eventually, the dollar? And most importantly, are we already seeing the early stages of that transition? If you want clear, no-nonsense breakdowns of where Bitcoin, global markets, and monetary systems are heading, make sure you like the video, subscribe, and drop your thoughts in the comments. It helps this channel reach more people who are trying to understand what's really happening beneath the surface. Buy $10,000 of Bitcoin on a regular exchange, it grows to $60,000. That $50,000 profit? You could owe $10,000 or more in capital gains tax. Now do the same trade inside a Roth IRA with iTrustCapital. That growth? Tax-free. You keep the full $50,000. Same crypto. Completely different outcome. iTrustCapital lets you hold crypto in a self-directed IRA, trade 24/7, and secure your assets with institutional-grade custody. You can also hold gold, silver, and stake certain assets. Real U.S. customer support. $100 bonus when you fund through the link below. In crypto, structure beats timing, every time. Thanks for your support, and enjoy the video.
Do you think Bitcoin will be the world's reserve currency one day and widely held by central banks? And if so, what would it take for Bitcoin to actually clear that hurdle?
I think it has the potential to be, in the sense that it is designed in such a way that it has that capability. Right now, it's a 17-year-old asset. It's currently under a 2 trillion market cap. For at the higher end of its price point, it was over a 2 trillion market cap asset. So it's still, even on its best day, it's still fairly small in the global sea of capital. At the best, it was like 10 times. It was like a tenth the size of the gold market. Now it's like a 20th the size of the gold market. Rough numbers. But what's interesting kind of for it is that, like I said before, one, it's a store of value. Gold gets debased by 1.5% or 2% a year on average. Bitcoin has no long-term debasement after its kind of finite block subsidies kind of hit their ceiling. By the 2030s, we'll have like 99% of Bitcoin's mined. And two, when countries want to have these alternative payment systems that can't be shut off by external entities, Bitcoin's a fast settlement. Instead of literally just flying, planes of gold to each other, or relying on a credit-based system, which again can just be frozen or confiscated in many ways, a Bitcoin transaction can be sent and audited, depending on the size and how many confirmations you're looking for. Within the hour. There's basically both a settlement and a store of value aspect that's really valuable. I think the headwinds against it, one, is still too small. It's something that as some countries can dabble in to varying degrees, but no country's going to say this is like we're going to very few countries say this is our primary reserve asset when it can go up and down by 80% in a very short period of time. Um, I think they want to see it operate for longer, right? So there's always kind of new technical FUD in the way. Like people say, well, what about minor centralization? What about quantum? What about this and that? When a system's run for 17 years pretty well, they're like, okay, you have my attention, but let's see what it looks like at the 30-year mark or the 40-year mark. And if at 30 or 40 years, Bitcoin is much larger just because more and more private entities have decided to hold it, and around the margins, some sovereign wealth funds and central banks have decided to hold it. It can become more self-reinforcing over time as kind of if it continues to not be truly disrupted by technical threats. It kind of gets more and more Lindy. The Lindy effect kind of increasingly kicks in, as well as that self-reinforcing size and liquidity over time. And it makes sense that it would show up in sovereign wealth funds generally earlier than central bank reserves, because a sovereign wealth fund, the purpose of one of those is more for longer term investment. Um, and so when you have a very volatile asset like Bitcoin, it doesn't match any of your liabilities. It can go up dramatically in price, or it can fall dramatically in price. It's generally not the asset you're gonna keep on hand for like working capital reserves, where you're gonna like sell some to backstop your currency. Instead, you're more looking at it as a longer term investment. So you stick it in something like a sovereign wealth fund, whereas the central bank reserves themselves, they're generally meant to be lower volatility assets, treasuries and gold and things like that, even currency deposits. And so I think it has to kind of climb that ladder in terms of how widely held it is, how much does that over time increase the market cap, increase the liquidity, reduce volatility, keep proving that it can survive various technical questions or challenges. And then the more it does that, I think the more it can be attractive as a reserve asset.
What Lyn Alden makes clear here is that Bitcoin already has the properties of a reserve asset, but not yet the scale or stability required for global adoption. It's scarce, it settles quickly, and it can't be controlled by any single entity. But at its current size, and with its historical volatility, it's still not something central banks can rely on for day-to-day reserves. Instead, the transition, if it happens, will likely be gradual. Alden points to a clear path: first adoption by private entities, then sovereign wealth funds, and only later central banks. Over time, as liquidity deepens and volatility declines, Bitcoin could become more self-reinforcing. The longer it survives, the more credible it becomes, and that's where the Lindy effect starts to take hold. Which leads directly into the next critical question. If Bitcoin is still early, why does Alden believe it's the solution to a broken monetary system in the first place? What makes it fundamentally different from every other financial innovation we've seen before?
Why Bitcoin is the right solution to our broken money system.
I mean, at the core of it, I think it's because it's the invention of fast settlements. So it's most technological innovations are layers on top of the current system, which is that almost every friction in finance gets solved by another layer of centralization, right? So if two people are having frictions doing finance, they say, okay, we're gonna use this banker. And so whenever you sell me stuff, I can just say, okay, subtract from my account, put it in his account, and vice versa. Now, if there's multiple banks in a region, and we're getting annoyed by the frictions of what if you use a different bank than I use, um, then they start establishing kind of a central bank that kind of connects a lot of those banks and allows those to settle very quickly. And then when you have international operations, you say, well, we kind of need like a super central bank that a lot of ours can kind of connect to. And so you get like four layers deep of increasing centralization. And what's interesting about Bitcoin is, I mean, a lot of that is basically gold was slow. Any sort of like just settlement is slow. Transactions globally want to be very fast. So, like I said before, we became increasingly reliant on these centralized intermediaries. Um, and Bitcoin comes along and says, okay, you've had a century and a half of a technological mismatch of fast transactions but slow settlements. Here's the invention of fast settlements, meaning that you can send value in a way that is irreversible, and that no one entity can just reverse that transaction. So then you test it for years and decades. You see that it works because I mean you could propose the idea and it works for a couple years and then some instability makes it not work. This is the first one that kind of had a lot of pieces together that really kind of made it work. The difficulty adjustment in particular was a massive step forward. There were attempts before, like the closest one would have been something like reusable proof of work tokens that Hal Finney had kind of put forth. Satoshi kind of continued refining ideas that were like that and made the system that works. And the significance of it is now people can on a decentralized network store value that can't be debased, and they can send value in a permissionless, decentralized way. To the extent that that grows over time, it's a pretty big competitor to the current way of doing things. It's at least an alternative. I think it's the right solution because when you look at the history of what makes one protocol win versus another, uh, you know, generally when a protocol becomes solidified, it's very hard to disrupt and it becomes self-reinforcing. It's kind of like why do we have Ethernet as our kind of primary networking protocol? Surely someone could make a slightly better one. I mean, it does improve over time; it gets faster. But the main reason is that no matter how good one you make, unless it's like an order of magnitude better, it can't compete. It can't compete with the fact that there's like already 10 billion devices in the world that have Ethernet ports on them. Same thing with USB. Same thing with building on simple mail transfer protocol or TCP/IP. When you get these protocols in effect, they have network effects that are very kind of self-reinforcing. And Bitcoin, it's kind of the protocol of value transfer, the protocol of kind of digital money. And the other thing that protocols have in common, first, you have that early lead, you kind of establish that dominance. But then two, the best protocols are generally very simple, and they generally scale through layers. So the core thing that no one can control kind of has to be really dumb and simple, because if it's got to be changed a lot, or there's a lot of variables that are tweakable, that kind of implies there's going to be a lot of governance there, and there's going to be kind of disagreements and more attack surface for how to tweak those variables. Whereas when you have the core thing be like just elegantly simple, and most of the complexity is pushed to the periphery, to higher layers. It allows that kind of core one to be very rarely changing in any material way, and you can kind of have it operate in an almost anarchy type of situation where there's no one really in control of it because no one has to be in control of it because it's not really something you need to change. It's just it's doing a very simple core layer thing. And I think kind of compared to other cryptocurrencies, Bitcoin really meets that definition. So the combination of early mover advantage, self-reinforcing network effect of liquidity and security, and then that really simple kind of dumb design are all features for why it can win.
As Alden explains, Bitcoin has always functioned as an alternative, a parallel system you can turn to when the traditional one fails. But for it to truly challenge the global monetary order, it needs scale. Not just incremental growth, but an order of magnitude expansion. The kind of scale where sovereign entities can meaningfully allocate to it, the way they do with gold today. And getting there won't be a straight line. Alden makes it clear that this process is naturally cyclical. Rapid adoption leads to euphoric price surges, which then lead to leverage, excess, and eventual corrections. Those corrections shake out weak hands, reset the system, and force Bitcoin to rebuild, stronger each time. It's a zigzag path, not a smooth curve. And alongside that, Bitcoin still has to do something even more important: survive. Every cycle brings new doubts: mining centralization, network security, quantum computing risks, fee sustainability. Alden's point is simple: Bitcoin doesn't silence these concerns overnight. It outlives them, and over decades that track record becomes its strongest argument. Now, this ties directly into a recent observation from on-chain analyst Willy Woo, who puts Bitcoin's current position into perspective. His tweet reads, "Most Bitcoiners think Bitcoin is a safe haven asset, but the truth is nuanced. It has the properties of a safe haven asset. In times of war, you can take your seed phrase, cross borders, and start afresh without losing your wealth. It should be independent of the system and thrive if it collapses. These are the properties you'd expect of a safe haven. BTC has the properties of a safe haven, but to this day, in times of uncertainty and war, it trades like a risk asset, very sensitive to uncertainty. This is because the large capital pools don't acknowledge Bitcoin's properties as it's considered too new and untested. Hence, it trades like the Nasdaq. It'll take another decade for it to gain market acceptance as a safe haven, maybe longer. When it does, it'll give gold market cap a run for its money. What Woo is describing is exactly what Alden is outlining from a macro perspective. Bitcoin already has the properties: scarcity, portability, censorship resistance, and fast settlement. But markets don't price properties, they price confidence. And confidence takes time. Right now, Bitcoin sits in this in-between phase. It's too big to ignore, but still too young to fully trust. That's why it behaves like a risk asset in the short term, correlated with liquidity, sensitive to macro shocks. But underneath that volatility, the foundation is still being built. And if Alden and Woo are right, what we're witnessing isn't the final form of Bitcoin, it's the transition phase. The period where it moves from speculative asset to strategic asset, and eventually to a core part of the global financial system. The real question isn't whether Bitcoin has the properties to get there, it's whether it can survive long enough and grow large enough for the world to finally recognize them. If you found this breakdown valuable, make sure you like the video, subscribe to the channel, and share it with someone who's trying to understand where Bitcoin is really headed. Drop your thoughts in the comments. Do you think Bitcoin becomes a true safe haven, or does it stay a risk asset? Thanks for watching, and I'll see you in the next one.